What's up guys, Steven Dux here. Welcome to the new weekly recap. And today we're going to focus more on liquidity issues and a little bit more on the technical side other than the beginner. Today we're going to talk about KTOV, IZEA, and CCCL. So liquidity issues is basically volume issues. When the volume is not existing and the stock is heading into either resistance or support, it doesn't really matter if you trade it because nobody was trading the stock because the candles are moving back and forth based on people buying and selling. If there's no people are buying and selling, it doesn't matter, it hit the support, doesn't matter, it hit the resistance, it's not going to move. And sometimes you have liquidity issues and you have a large amount of shares stuck in one stock. It's really dangerous for you to get out or exit the stock because you have so many shares, you will affect the stock price and there's not enough bid or ask to execute your shares. Then you're gonna get really bad execution. Then you will basically taking a loss for nothing. This is what happens on IZEA. People thinking, okay, the stock is heading to resistance, but there's not actually volume existing on the stock, and people are still thinking about shorting it. Some people get executed really bad, and they waited for all day. The stock didn't crack because there's no volume. So that's something you need to keep in mind. If the stock didn't spike on the day before, and is losing volume, then it can be a shortable stock. But if the stock began with no spikes, it just comes in with no volume, then you can't trade it because liquidities. Now KTOV, now there's another thing I want to talk about is Nasdaq Area, because a lot of the tickers, when they're around 70 cents to $1, it is a very dangerous area because the company wants to hold their stock above 1. If the stock is now above 1, they don't meet the Nasdaq criteria and they are risking to get delisted. They want to try their best to hold the stock above 1, and when the stock spikes to 1.35, and they automatically assume there's going to be a lot of manipulation going on and trying to hold the stock above 1, so you're trying to struggle in this 1.09 area. If you keep shorting it, you won't do anything for it because the stock is above 1 for a while. It's really hard to short into gap up barely over 1 stocks. That is the reason I don't touch all those. If they're crowded, they're barely over 1. It's not even my price range. That's why I don't touch all those between 0.8 to 1.5, this kind of range tickers. CCCL, this is the ticker that happened, I will assume, on Wednesday, and the stock was very crowded. I think it traded around 20 million shares on that day, 16 million shares. Yeah, so for stock trading 60 million shares and their flow is 1 billion, it traded about 16 times of its flow and 6 times of the flow rotation. All those tickers will get super crowded. When low flow gets crowded, when they're trading between mass amount of rotations, they can be either very bullish or very bearish. Now, it leans towards to bullish sectors than the bearish, because if there's no major momentum breakdown, the stock is likely to stay bullish when they are flow rotating for 16-20 times. And also, the reason why I don't want to short either CCCL, because if you look at the yesterday's support, mass consolidation at 1.5 to 1.6 area, when the stock breaks its momentum, falls into that support, bounce right back to the day high. First, if you are shorting to the breakdowns, you are shorting to a support. That is very dangerous because there's support, momentum breakdown, and the bullish factors and the bearish factors are conflicting each other. And especially on low flow, when they're conflicting, you cannot short them. That's exactly how the stock bounced back, squeeze the shorts again, and slow fade in the afternoon. So that's why I always stay away from low flow that trades 10 times of its flow rotation on that day. And I will much likely to wait until the next day to either short it or go long, because with a massive amount of flow rotation, it's pretty much unpredictable for micro flows under 2 million. Also, I want to go over one of the questions that people ask me a lot. How do you, when the stock performs a fake out and you get faked out and the stock goes into ways that you're expected, would you chase or no? The answer is no, because when the stock messes you up at once and the second time you want to go in, you are more likely to be emotional. And when you're emotional, you cannot trade the stocks. You have to always stay rational. When you make one mistake on a stock, I never trade it again. I just skip it, and there's opportunities comes in the market as always. I always focus on the perfect setups. I want to get my risk management right. I want to get my risk within 10% of my entire positions, and I want to get my risk reward of 1 to 4 or 1 to 2 in normal, or 1 to 4. That's the best. If the stock doesn't meet a single criteria out of 10 criteria, I don't trade it. I only trade the best criteria. That is how you can stay consistent, profitable, because people are trading something that they're not comfortable with, and they're testing strategies, or they messed up at once and they want to go into second time being emotional and messed up again. Then it just keeps the chain reaction. You want to always stay fresh. When you messed up one, just move on to the next, because this is not married to one stock. This is not married to one stock again. Trading Amazons or trading all those big market cap. In penny stocks, tickers comes in every single day, different tickers, different situations, and you can always grab a lot of opportunities. So that'll be the weekly recap for this week. Hopefully you guys had a great new year, and I will see you guys next week.